$100 silver has reached many parts of the world. $100 silver has reached much of the world, but what they're not showing you is the panic happening behind closed doors. In 14 countries, that line has already been crossed. While central banks face subpoenas, while registered silver inventories drop to levels that make traders go silent, while entire nations are paying double-digit premiums just to secure physical metal. The question isn't whether silver hit $100. The question is, what happens when the business community realizes their currency can no longer buy what 1 ounce used to cost? And more urgently, what happens when institutions with billions to deploy discover there's not enough metal left to fill the orders? Welcome to Currency Archive. Now, if you've been in business long enough to remember when a handshake meant something, when contracts were honored, and when a dollar actually held its weight, then you already understand what's unfolding here. This channel exists for professionals who've seen enough cycles to recognize when the rules are changing. So do me a favor. If you value analysis that respects your experience and doesn't waste your time, go ahead and hit that subscribe button right now. We don't chase headlines here. We track capital flows, supply disruptions, and monetary reality. And before we dig into what the institutions hope you'll ignore, drop a comment below and tell me, where in the world are you watching this from? Because what's happening to silver isn't isolated to one region. It's happening everywhere. And I want to know if you're seeing it in your markets too. The business community has been watching silver approach $100 per ounce with a mixture of curiosity and caution. What most have failed to recognize is that this milestone has already been crossed. Not once, but 14 times. In Argentina, Turkey, Egypt, Nigeria, Brazil, South Africa, Pakistan, Bangladesh, Lebanon, Zimbabwe, Venezuela, Iran, Sri Lanka, and Ghana, silver has breached the $100 threshold when priced in local currency. This is not a story about precious metals. This is a story about currencies losing the ability to measure value. When an ounce of silver costs 100 units of currency in one nation and 50 units in another, the metal has not changed. The measuring instrument has. What the financial media frames as a silver rally is actually a disaggregated currency crisis, one that is revealing which monetary systems are failing first and which will follow. The business professional who mistakes this for a commodity trend will be positioned incorrectly when the pattern reaches reserve currencies, and the pattern is already in motion. The divergence in silver pricing across national borders is not gradual. It is accelerating. In nations where $100 silver has already arrived, the move was not preceded by warnings from central banks or acknowledgments from finance ministries. It simply happened. 1 month, silver traded at the equivalent of $70 in local currency. The next month, it was $85. Within a quarter, it crossed $100, and the premiums for physical delivery began compounding on top of the nominal price. This is the signature of purchasing power collapse, not the dramatic hyperinflationary spirals that make headlines, but the quiet, relentless erosion that destroys savings before the public realizes what has been lost. The mechanism is straightforward. When a central bank loses credibility, either through policy error, fiscal dominance, or external pressure, the currency begins trading at a discount to hard assets. Silver, being both monetary and industrial, becomes the immediate reference point. Importers who require physical silver for manufacturing cannot wait for currency stabilization. They pay the premium. Investors who recognize the monetary decay rotate into tangible stores of value. They pay the premium. Businesses that operate across borders and need to preserve capital through currency fluctuations convert liquidity into metal. They pay the premium. The result is a two-tier pricing system. The official spot price quoted in dollars and the actual transaction price required to secure delivery in local markets. What makes this development strategically significant is that it is no longer confined to frontier economies. The same premium structure that appeared in Argentina 18 months ago is now visible in parts of Europe. The same delivery delays that characterized Turkish silver markets in early 2024 are now being reported in secondary financial centers. The pattern is not reversing, it is expanding. And the business community that ignores this expansion because it has not yet reached their home currency is making the same error that wiped out an entire generation of wealth holders in nations where $100 silver has already arrived. The United States dollar, euro, and Japanese yen have not yet experienced this divergence at scale. Silver priced in these currencies remains in the low to mid-90s as of this analysis, but the structural conditions that produced $100 silver in 14 other nations are not absent in reserve currency economies. They are simply delayed. Central bank balance sheets in these jurisdictions have expanded by trillions. Debt-to-GDP ratios have crossed thresholds that historically preceded currency crises. Real interest rates, after accounting for actual inflation in goods that matter, energy, food, healthcare, housing, remain deeply negative. The only difference between a reserve currency and a collapsing currency is time and perception, and both are finite resources. The business professional must understand that $100 silver in multiple jurisdictions is not an isolated occurrence. It is a leading indicator. It reveals that the global monetary system is not repricing uniformly. It is fragmenting. Some currencies are losing credibility faster than others, and the populations holding those currencies are discovering that their lifetime of savings can no longer purchase what 1 ounce of metal commands. This is not theory. This is observable fact, playing out in real time across multiple continents. The strategic implication is direct. If 14 currencies have already lost the ability to price silver below $100, and if the structural conditions in reserve currency zones mirror those that produce the breakdown elsewhere, then the question is not whether the dollar, euro, or yen will follow. The question is when. And the secondary question, the one that will determine who preserves wealth and who does not, is whether the business community will recognize the pattern before it reaches their balance sheet, or whether they will wait until $100 silver is no longer a foreign phenomenon, but a domestic reality. The nations where this has already occurred did not see it coming. Their central banks issued reassurances, their finance ministries projected stability, and their currencies collapsed into triple-digit silver anyway. The lesson is not that collapse is inevitable. The lesson is that collapse is not announced. It is discovered. And by the time discovery happens, repositioning is no longer possible at favorable terms. The United States Department of Justice does not issue grand jury subpoenas to the Federal Reserve as a matter of routine procedure. When such an action occurs, and when the chair of the central bank addresses it publicly, attributing the legal pressure to dissatisfaction over interest rate decisions, the event carries weight that extends far beyond monetary policy. What happened in the 48 hours following that public exchange was not captured in headlines. It was captured in order flow. Within 2 trading sessions, silver futures contracts began experiencing volume spikes at price levels that had previously acted as resistance. The gold to silver ratio, which had held stubbornly in the mid-60s for months, compressed into the low 50s. This was not retail speculation. Retail investors do not move ratios that have remained range-bound for quarters. This was institutional repositioning, large, coordinated, and executing with the kind of urgency that suggests access to information the broader market has not yet processed. The business professional who dismisses this as coincidence is operating without a framework for understanding how capital moves when confidence in monetary authority begins to crack. Markets do not wait for official announcements. They do not require validation from government agencies or central bank communications. When the institution that controls the world's reserve currency faces the possibility of criminal investigation, the question asked by every major allocator of capital is simple and binary. Can policy still be trusted? And when that question enters institutional decision-making, the answer is expressed not in words, but in positioning. The COMEX registered silver inventory, the portion available for immediate delivery against futures contracts, declined by over 40 million ounces in the 3 months preceding silver's move toward $100. This was not a gradual draw. It was a sustained, methodical extraction of physical metal from the exchange-monitored system. Someone was taking delivery. Someone was removing silver from the paper pricing mechanism and converting it into allocated, identifiable, physically segregated metal. The identity of those entities has not been disclosed, but the behavior reveals intent. When sophisticated actors pull metal out of registered inventory during a period of rising premiums and tightening supply, they are not speculating on short-term price movement. They are securing position ahead of a structural event. What makes this particularly instructive is the timing. The inventory drawdown did not occur after silver broke to 80. It occurred while silver was still trading in the 70s, while the financial media was still debating whether the metal had further upside, while retail sentiment remained mixed. The institutions that moved early were not reacting to price. They were positioning ahead of it. And the mechanism they used, physical delivery and removal from registered stocks, sends a clear message. They do not trust the paper market to function under stress. The evidence extends beyond COMEX. Silver-backed exchange-traded funds saw inflows exceed 15 million ounces during the same 3-month window. The largest sovereign accumulators, China and India, increased their documented silver imports by measurable volumes even as premiums in their domestic markets began widening. Mining companies that had previously sold forward production, essentially locking in prices for silver they had not yet extracted, began buying back those contracts, unwinding hedges at a cost in order to regain exposure to spot pricing. This is not the behavior of an industry that believes prices have peaked. This is the behavior of producers who recognize they sold optionality at the wrong time and are willing to pay to reacquire it. The gold-to-silver ratio compression is particularly revealing. Historically, when the ratio moves from the mid-60s into the low 50s, it signals that silver is outperforming gold on a relative basis. But outperformance alone does not explain the speed of the move. What explains it is the recognition among institutions that silver carries a dual function, monetary and industrial, and that the industrial demand base is no longer elastic. when solar panel production schedules cannot be delayed, when electric vehicle manufacturers cannot substitute away from silver without sacrificing performance. When defense contractors require specific quantities for weapon systems that are already contracted, the metal becomes a required input rather than a discretionary purchase. And when required inputs face supply constraints, price is no longer the governing variable. Availability becomes the constraint. The subpoenas served to the Federal Reserve, regardless of their ultimate legal outcome, introduced a variable that institutional allocators cannot ignore: political risk inside the monetary authority itself. Central banks operate on the assumption of independence. When that independence is publicly questioned by the Department of Justice, the assumption breaks. And when assumptions break, capital does not wait for resolution. It repositions. The fact that silver and gold both moved higher within 48 hours of that public exchange is not speculative interpretation. It is documented price action occurring in direct temporal proximity to a confidence-eroding event. The business community must understand what this sequence reveals. Institutions with billions in assets under management do not move based on headlines. They move based on risk assessment. And when the institution that underpins the global reserve currency faces legal scrutiny while silver inventories are being drained, and premiums are widening across multiple jurisdictions, the risk being priced is not inflation. It is systemic fragility. The move toward $100 silver was not driven by momentum traders or retail enthusiasm. It was driven by capital allocators who recognized that the conditions sustaining confidence in paper pricing mechanisms were deteriorating faster than public discourse acknowledged. The question now is not whether institutions positioned early. The question is whether the business community recognizes what that positioning signals about the phase of the market they are entering. There exists a category of market stress that does not announce itself through headlines or price volatility. It reveals itself through delivery timelines. When institutional buyers place orders for physical silver and are told that settlement will occur in 12 weeks rather than 2, when refiners begin quoting lead times instead of spot availability, when premiums begin compounding on top of premiums, not because of speculation, but because metal simply cannot be sourced at any reasonable speed. This is not a pricing problem. This is a structural deficit that price alone cannot solve. Global silver mine production has remained effectively flat for the better part of a decade, hovering near 800 million ounces annually. During that same period, industrial consumption has grown by over 200 million ounces per year. The arithmetic is unambiguous. The world is consuming more silver than it is producing, and the deficit is being filled by above-ground inventory that is not infinite. What makes this particularly consequential is that the industrial demand base is no longer discretionary. It is embedded in supply chains that cannot function without the metal. Solar panel manufacturing consumes approximately 140 million ounces of silver annually, and that figure is accelerating. The International Energy Agency projects solar capacity installations will triple by 2030 under current policy frameworks. Silver is used in photovoltaic cells because no substitute delivers comparable electrical conductivity at the required thickness. Engineers have attempted to reduce silver loading per panel, and they have succeeded in marginal reductions, but they have not eliminated the requirement. Every panel installed represents a permanent withdrawal of silver from available supply. It does not return to the market. It is embedded in infrastructure with a 25-year lifespan. Electric vehicle production consumes roughly 35 million ounces annually, a figure that has doubled in 3 years. Silver is used in EV battery contacts, charging infrastructure, and the power electronics that manage energy flow between the battery and motor. The automotive industry is not designing around silver. It is designing with silver because the performance characteristics required for high current, high cycle applications do not exist in cheaper alternatives. Manufacturers are not choosing silver based on cost. They are choosing it based on physics. Defense and aerospace applications consume an additional 10 million ounces per year, concentrated in missile guidance systems, radar arrays, and avionics. These are not applications where cost reduction drives procurement decisions. These are applications where failure is not tolerable, and silver's thermal stability, conductivity, and resistance to corrosion make it the material of choice. Military procurement contracts are negotiated years in advance, and the quantities specified in those contracts are not flexible. When a defense contractor is obligated to deliver 5,000 units of a weapon system, and each unit requires a specific quantity of silver, that demand is fixed. It does not adjust to spot price. It must be filled. What occurs when annual consumption exceeds annual production by 150 to 200 million ounces is mathematically simple. The difference must come from existing inventory. The challenge is that existing inventory is not held in centralized, transparent locations. It is distributed across private vaults, ETF holdings, jewelry, coins, and industrial stockpiles. Much of it is not available for sale at any price the current market would consider reasonable. The silver, held in religious artifacts, family heirlooms, and long-term allocated storage, is not coming to market because the price moved from $70 to $100. It is being held because the holders do not view it as a trading position. They view it as a store of value that appreciates in importance as confidence in paper currency declines. Refiners have begun signaling what the market has been slow to acknowledge. Orders that once settled in weeks are now being quoted in months. Large institutional buyers attempting to acquire 1 million ounces or more are being told that such quantities cannot be delivered in a single tranche. They must be staged over quarters, with pricing locked at the time of each delivery, not at the time of the order. This is not a liquidity problem. Liquidity problems are solved by paying higher premiums. This is an availability problem, and availability problems are solved by waiting or by not being able to acquire the position at all. The two-tier market structure that emerged in frontier economies is now appearing in developed markets. Retail buyers can still acquire silver, but at premiums that range from 15% to 30% above spot. Institutional buyers can acquire silver, but not immediately and not at spot. The official price quoted on exchanges reflects contracts that settle in paper, not metal. The actual price required to take delivery reflects the reality that physical silver is no longer abundant enough to satisfy demand at the prices the paper market suggests. What institutions are quietly pricing in is not a temporary supply disruption. It is a permanent re-rating of availability. When industrial demand is inelastic, when above-ground inventory is diffuse and largely non-commercial, when mine production cannot respond quickly, even if prices double, the market enters a regime where price discovery breaks down. Price is supposed to allocate scarce resources by rationing demand. But when demand cannot be rationed, when solar panels must be built, when electric vehicles must be produced, when defense systems must be delivered, price ceases to be the equilibrating mechanism. Allocation becomes the mechanism. And allocation does not favor latecomers. The business community must understand that $100 silver is not occurring in a market with surplus capacity. It is occurring in a market that has been running a structural deficit for years, and where that deficit is now colliding with industrial demand that cannot be delayed. The institutions that positioned early, that pulled metal from registered inventory, that secured refinery capacity ahead of the rush, were not speculating. They were solving a supply problem before it became unsolvable. The question facing those who have not yet positioned is whether they are entering a market where metal is available or a market where metal is being allocated to those who acted first. There's a moment in every monetary transition when the rules governing capital preservation change without announcement. The business professional who operates under the assumptions of the prior regime, who believes liquidity is safety, who trusts that currency holdings represent stable purchasing power, who assumes that institutional counterparties will honor paper commitments under stress, discovers too late that the framework has shifted. What separates those who preserve wealth through such transitions from those who do not is not prediction. It is recognition. And recognition requires distinguishing between a price event and a structural signal. $100 silver in multiple jurisdictions simultaneously is not a price event. It is a structural signal. It indicates that the monetary system is no longer repricing uniformly, that confidence is fragmenting across currency zones, and that the business community must now operate in an environment where the medium of exchange itself has become a variable risk. The implications for corporate treasury management, cross-border operations, and balance sheet construction are immediate and non-trivial. Consider the position of a business that generates revenue in one currency and holds obligations in another. Historically, such exposure was managed through forward contracts, currency swaps, or holdings of sovereign bonds in the obligation currency. These instruments functioned because they were backed by the assumption that central banks would defend currency stability and that governments would honor debt commitments. When central banks face subpoenas, when debt-to-GDP ratios exceed levels historically associated with default or debasement, and when physical assets begin trading at sustained premiums to paper instruments, that assumption is no longer reliable. The hedges themselves become sources of risk. The treasury manager who holds a portfolio of bonds issued by a government running 6% fiscal deficits while its central bank faces legal scrutiny is not hedged. They are exposed. The bond may pay its coupon in nominal terms, but if the currency in which that coupon is paid loses 15% of its purchasing power during the holding period, the hedge has failed. This is not a theoretical scenario. It is the lived experience of treasury managers in the 14 nations, where $100 silver has already arrived. They held what they believed were safe assets, denominated in their domestic currency, and discovered that safety was an illusion, denominated in a unit of measure that was collapsing. The alternative is not to abandon liquidity entirely. Businesses require operational cash flow. They require the ability to meet payroll, to settle supplier invoices, to manage working capital through revenue cycles that are not perfectly synchronized. The question is not whether to hold currency. The question is how much, in what form, and with what contingency plan, for when the currency's purchasing power begins deteriorating faster than the interest it earns. This is where silver's dual nature becomes strategically relevant. Unlike bonds, silver does not carry counterparty risk. Unlike equities, it does not depend on corporate earnings or management competence. Unlike real estate, it is liquid and divisible. Unlike cryptocurrencies, it has 5,000 years of monetary history and cannot be confiscated through a software update. Silver functions as both a monetary asset and an industrial commodity, which means its value floor is supported by physical demand that exists independent of investor sentiment. For businesses with international exposure, the decision architecture must account for timing risk, allocation size, and custody structure. Timing risk is the risk of rotating into hard assets too early, sacrificing yield and liquidity during a period when currency stability holds. Allocation size is the percentage of liquid reserves that should be converted into non-yielding physical stores of value. Custody structure is whether the metal is held in allocated form, in a vault the business controls, or through an intermediary whose solvency becomes a dependency. The framework for addressing these questions is not universal. It depends on the nature of the business, the currency zone in which it operates, the time horizon over which capital must be preserved, and the tolerance for basis risk between the price of paper silver and the price of physical delivery. But there are principles that apply broadly. First, liquidity held in currencies that are experiencing subpoena-level institutional stress should be minimized to operational necessity. If a business requires 90 days of operating expenses in liquid currency to manage cash flow, then 90 days is the holding. The remainder should not be kept in a currency whose issuing authority is under legal investigation. This is not speculation. This is risk management. Second, the rotation into hard assets should prioritize physical delivery over paper exposure. The silver ETF that promises redemption in metal is not the same as metal held in allocated storage under the business's direct control. When supply constraints tighten, when premiums widen, when counterparties face stress, the difference between a claim on metal and possession of metal becomes the difference between preservation and loss. Third, the business community must recognize that operating in a fragmenting monetary system requires treating currency exposure as a managed risk rather than a neutral position. Holding dollars, euros, yen, or any fiat currency is not a passive decision. It is an active bet that the issuing central bank will maintain credibility, that fiscal authorities will demonstrate restraint, and that the political system will prioritize monetary stability over short-term expediency. In the 14 nations where $100 silver has already been reached, that bet failed. The business operators who understood this early enough to act preserved their capital. Those who did not are now attempting to acquire hard assets at prices and premiums that reflect the desperation of late recognition. The challenge facing the business community in reserve currency zones is that they are observing the pattern in foreign markets, while operating under the assumption that their own currency is exempt. It is not exempt. It is simply later in the sequence. The structural conditions, expanding central bank balance sheets, unsustainable fiscal paths, legal, and political pressure on monetary authorities, supply deficits in physical assets, are not absent in dollar, euro, or yen zones. They are present. And the institutions that are draining registered silver inventory, that are buying back forward hedges, that are accepting 12-week delivery timelines to secure physical metal, are not doing so because they believe reserve currencies are invulnerable. They are doing so because they recognize that vulnerability does not announce itself. It is discovered. And discovery happens after the opportunity to reposition at favorable terms has closed. The business professional does not need to predict when $100 silver will reach their home currency. They need to recognize that the pattern is in motion, that the conditions are replicating, that the cost of early positioning is lower than the cost of late recognition. The decision is not whether to act. The decision is whether to act while terms are still negotiable, or whether to wait until allocation replaces price as the governing mechanism, and discover that the metal they needed to preserve capital is no longer available at any price they can afford.